Welcome to Early Edge Club. We are a small cohort of serious microcap investors. Every month, we deep dive into two microcap stock chosen by the community. We are keeping this group small intentionally to preserve the quality of discussion and make a real personal connection. If that sounds like the kind you want to be part of, fill out the short form linked in the description and we will reach out to you soon. Today's section is divided into understanding first the business model, the industry, and then we use our 20-factor scoring, and finally our take on valuations and risk. Just to be clear, this is not an investment advice. Our goal is to help you invest smarter and safer and not tell you what to buy.
Today we are going to take a deep dive into Laxmi Dental. So Lakshmi Dental is one of the only end-to-end integrated dental products company in India. It is the largest and most profitable vertically integrated indigenous B2B2C dental aligner solutions provider. The company's revenue breakup is as follows. 61.8% of its revenue comes from laboratory offerings, 32.3% comes from aligner solutions, and 5.9% from others. Now, the company is India's only end-to-end integrated dental products company, and it has basically two major product verticals, which include laboratory offerings and aligner solutions and pediatric dental products. In laboratory offerings, it has two forms of business. One is the domestic one, and another one is the international one. In the domestic landscape, it sells under the brand name Illusion, and in the international landscape, it is widely popular as Lakshmi Dental itself. For aligner solutions and pediatric dental products, for aligner solutions, it has got two brands. One is Illusion Aligners and one is Taglus. And for pediatric dental products, it has Kids eDental. The company has been operating for more than 20 years with 22,000 plus network of dentists. It is operating in 95 plus countries with 300 plus cities. It has got 6 manufacturing facilities and 2,300 plus employees. Now, the company is the largest and most profitable B2B2C indigenous dental aligner company. Its business model works as follows. So, the company manufactures and brands its products, and then it comes into contact with general dentists or orthodontists, and the orthodontists recommend their products to the patients. So the aligner revenues has been growing year on year considerably. It has grown 10x in last 3 years to 474 crores in FY25. Also, the revenues from different tiers of customers are as described follows. Majority comes from tier 1 customers, then from tier 2 and tier 3, providing a higher opportunity for deeper penetration into the tier 3 plus cities. Also, their B2B2C model is very effective as it helps them to penetrate the markets for the existing pool of dentists, which helps them grow much faster as compared to their competitors. Now, the revenue by segment is as follows. For laboratory offerings, we can say there is a very decent balance between international and domestic revenue. Also, in aligner solutions, they have got two subsidiaries. One is BizDent and one is Vedya, and the revenue breakup among them is also decent. Some of the key highlights of the company as follows. So the company is the second largest player in domestic laboratory business and largest export laboratory with increased adoption of digital dentistry. And it has got a vertically integrated, diverse branded product portfolio with a large dental network. And the company explores a robust technological advanced capabilities with stringent regulatory compliance, ensuring high quality standards for its products. They've got a very experienced management team with multiple years of experience. There is some concerns regarding one of their promoters, which is Mr. Rajesh Khakar. So we'll come to that later in the discussion. Also, they've got a very good team of key managerial personnel with very good records and profile. Now, coming to the industry dynamics. So, dental disease burden is high in global as also in India, and dental care is underpenetrated according to the company. So, in global cases, number for select non-communicable diseases as of 2019 has oral diseases as the highest by a very high margin. Also, per capita dental healthcare expenditure is very low in India, as we can see, as compared to other countries. Also, oral disease burden in India and the other key countries is quite drastic. As we can see, India is much lesser in terms of other countries, so that's very good market opportunity which the company is trying to explore. Also, dentists per 10,000 population across key countries. Key countries is very good across other major countries, but it's very low for India, which is just two for every 10,000 people. So that's very less, and there is also scope for expansion in the OPD segment. Now, the market for Lakshmi Dental's offerings are sizable and growing. The global custom-made crowns and bridges market is growing at a CAGR of 8%. Same for the Indian segment is growing at a rate of 12%. Global clear aligners market is growing at a rate of 15%, whereas its Indian counterpart is growing at a much higher rate of 23%. And global pediatric dental crown market is growing at a rate of 8%, and for India is growing at a rate of 14%, which is their major segment. Also, there is growing awareness of oral healthcare and cosmetic dental products, and high prevalence of dental problems and underpenetration of dental care, and technological advancements in 3D printing, CAD, CAM technology, and teledentistry, which is acting as huge drivers for the industry's high growth. Coming to their business strengths, the company is the only integrated dental products company in India, and it's well positioned to capture industry tailwinds. As we can see, as compared to its Indian and global competitors, the company is providing a wide range of products and services, starting from custom-made prosthetics to clear analysis, aligner sheets, thermoforming machine, intraoral scanners, and pediatric crowns, much more than any of their competitors are providing. So they have the opportunity to cross-sell their products. So the company shift towards premium product with a significant rise in their share for metal-free crowns has also provided them a very good edge. Their product, Zirconia, has provided much better performance as compared to other metal, lithium discrete, and metal alloy products. It's strong, aesthetic, durable, as well as it's prepared for multiple use cases. So its domestic laboratory metal-free revenue share is around 55.9%, which is quite high. And the only company in India in specialized pediatric dental products is Lakshmi Dental. So that in that market also they have huge growth potential. They have around 18% market share is zirconia, 20% in composite, and 45% in steel. So that's a very good market share, and also it has huge potential for growth considering its projected growth is quite high. Also, their revenue mix for kids rental has increased considerably. However, it has stagnated a bit as compared to last year. So the management expects it to grow further. Also, they're engaging in efforts to establish a well-recognized brand, and they're doing promotions for this. So that way, brand sales as a percentage of revenue from operations has also increased over the years, as we can see. And 100% of revenues from kids e-dental products are also from branded products as of FY25. They've got a very large dental network. As we can see, 66% from the revenue comes from India, 20% from USA, 7.6% from UK, and 6.1% from other countries. So some of the company's strategies are as follows. So they plan to deepen their penetration amongst existing dental network while also expanding their dental network, and they are continuing to scale up their branded product offerings, and they're undertaking product enhancements of existing dental products, and they're also planning on launching newer products. All of this happens by enhancing manufacturing facilities with increased focus on automation and adoption of new technology. The company's financial performance is as follows. As we can see, revenue from operations grew. Segment wise also there has been good growth both in terms of BizDent and Vaidya. Also, their PAT growth is also quite nice with good PAT margins. Also, the pediatric kids dental has grown negatively in last 1 year. However, it has showed a significant growth as compared to FY23. Also, EBITDA and adjusted EBITDA has also grown well. So that way the company is very nicely positioned in this segment. Some of the bull case scenarios are as follows. The company is the largest and most profitable B2B2C dental aligner solutions provider. It's end-to-end integrated player in underserved yet growing market. Also, international tailwinds from US-China tariff shifts benefit India as a preferred sourcing hub, and they're working closely with 22,000 plus dentists, giving them a trusted B2B2C network. Also, Kids eDentals received Singapore regulatory clearance, paving way for further international expansion, for which the management has given a good guidance. Also, digital penetration jumped significantly. So, with further penetration planned, so this is also aid them in the revenue growth. Some of the bear case scenarios are as follows. They're heavily dependent on dentist adoption for digitization rollout, which creates execution risk. D2C competitors like Tootsie post threat through aggressive pricing and marketing. Also, international revenue ramp up may be delayed due to regulatory timelines, and heavy reliance on scanners and tech upgrades brings in maintenance and training costs for the company, which is going to be recurring in nature. Also, aligner market is crowded and is commoditizing fast. So it needs strong differentiation, which the company is already working on. Also, supply chain risk is there because of high supplier concentration, which we'll look into a bit later. So coming to the 20 factor scorecard, the company came up with the IPO in 2025 with almost 700 crore total issue, composing of fresh issue of 138 crores and OFS of 560 crores. They spend a portion of their fresh issue in repayment of borrowings, but a major chunk on investment in capex and general corporate purposes. So I give them a 5 year. Now, in the director and promoter track record, that director qualified people with a great track record. However, that CEO, Mr. Rajesh, who is the chairperson and whole-time director, has been engaged in some fraudulent practices. He was involved in a CBI case, although he was later released, but still it becomes important to take this into account. So I pessimistically rated it a 3. In RBTs, the relatives of directors and KMP are taking a salary of 3.5 crores in total. So it's very shady. So I gave them a 3 here. And adding to this, 4 directors resigned just before the IPO, drawing 2.9 crores each in those years. And 2 of the directors were direct relatives. So it shows that those directors were just puppets, and they were used to generate revenues differently so that it does not get reflect very large numbers on the books. And as soon as the IPO came, they started clearing the books, and so all of them resigned all together. So it raises questions among investors. And also, loan repaid by director was worth 3.5 crores. So they have taken significant loan from the company. However, they paid only 9 lakhs of interest. So their interest rate comes up to around 2.5%, which is quite less. So all this consists made give them a 3 here. Also, board composition and independence, I'm going to rate them 3 because in the previous year I mentioned 4 of their directors resigned. So that's very concerning. So I give them a 3 here. Also, KMP salary is decent, not quite high. So I'm going to give them a 5. And key person resignation, I'm going to give them a 3 since 4 directors resigned in 2024 and one other director resigned in 2023 as well. And their non-executive, non-independent nominee director resigned due to personal reasons. So I gave them a 3 here. Their statutory auditor resigned in 2024 due to preoccupation in other assignments. I still give them a 5 here because this resignation might be because of the IPO. They might not have the capabilities at present to manage the whole IPO at large. So that's why I did not rate them negatively. I gave them a 5 here. And auditor opinion has been unmodified over the years, and there hasn't been any credit rating opinion. So I gave them a 5 here. Regulatory and legal issue, they had a CBI case for allegedly indulging in corrupt and illegal practices to obtain confidential and classified information pertaining to an application for approving FDI investment in company. So for this, Mr. Rajesh Thakkar was arrested and the promoter got released by the court. So I gave them a 5 here, but I accounted for it in the promoter track record and subsequent parameters. Investor communication and disclosures are nicely available, so I gave them a 5 here. Regarding business concentration risk, they have high supplier concentration, so I gave them a 3 here. So it's a bit concerning. However, geography mix is quite good. So they have revenue from USA, UK and other countries as well. And revenue growth versus receivable has been robust. Receivable has been growing at a slight higher rate as compared to the revenue. However, revenue as a percentage of receivables as a percentage of revenue has been 15.3% only. So I gave them a 5 here. Operating cash flow by EBITDA has been 75%, which seems satisfactory. So I give them a 5 here. Their inventory trends are as follows. Inventory days is on the higher side. They are improving on the inventory days and they have shown significant improvement in the past 5 years. Still, I am going to give them a 3 considering the inventory days is 138. Also, cash conversion cycle is quite good because they manage the high inventory with the high payable days. So their cash conversion cycle comes up to 33. So I give them a 5 here. Capex as a percentage of revenue is 6.7%, which is quite good. Fixed asset turnover is good. Asset turnover is satisfactory. And return on investment capital is 45%, which is quite good. So I get them a 5 here. Debt and interest coverage is good. So I get them a 5 here. Liquidity position is also good. Regarding the return on capital employed, return on equity, and return on asset metrics, they have posted good numbers. It has taken a dip as compared to last year. However, the numbers are still impressive and the growth consistency is quite good with huge profit growth for the company. So I gave them a 5 here. Now coming up to the total scores. So they scored 42 out of 15 governance and promoter behavior and 46 out of 15 financial health. Summing up this score to 88 out of 100 in total. So coming to the valuation analysis.
So overall, a lot of structural tailwinds in the industry and for the company, but currently they're trading at 102 PE. So let's just try to understand if at the current price, whether the valuation is justifiable. Even if you take the current prices at around 500, and so based on the historical over the past few years, they have been growing around roughly average 20%, and that is what is reflected in the best case. And if they are going to maintain the same 18% operating margin, and if even if the PE re-rates, the current price stands at 57 on a 1 year forward basis, it would be justifiable, I believe, only if the PE still stands at 100. But these are expensive PE, giving very less room for error. So we have to be extremely cautious. So, however, let's take a longer time frame and see. So if you're having a longer time frame, whether entering at the current price makes any sense. Yes, there is some fixed asset purchases and etc. So ignoring that, let's just take the cash flow from operation, which is at 44. They did net profit of 32. So let's take a net profit to be a bit more conservative, which is again similar to the free cash flow. And given this is more of a non-cyclical structural business, we will consider that a expected return is 15% and a terminal growth rate of 3. And if we have 5 years of holding period and a 50 PE at the end of 5 years, then the implied earnings growth rate should be around 25% for us to realize a 15% CAGR. Again, the company has been, and the industry, if you take all the 3 segments on an average, has been growing. The growth rate is projected to be around 15% for India and lesser for the global. Company can grow a bit faster, giving it a maximum of 22%. But for you to realize 25%, for it to grow at 25%, there should be something that the company has to do drastically different, and that too for you to realize just 15% return CAGR. So at the current price, at least for me, it looks a lot of positives are already factored in. I would wait for any meaningful correction to get into it if I were an investor at this current point in time. Any final thoughts?
Since you mentioned that the company is not cyclical, but we should not neglect the fact that the company is exposed to economic cycles where their product belongs to a very niche segment, especially when the company has specifically mentioned how in countries like India, dental care is not highly prioritized. So when economic downturn happens and we enter a season of recession, so that 20-25% growth rate is unlikely to sustain. So in such situation, how the company performs, it becomes very important to justify the current valuations. So it's better to wait and look.
I hope you found this framework useful. If you follow this company or have any interesting insight, we would love to hear from you. Drop a comment below. If you have scored this company using our 20-factor scorecard, feel free to share your score and how it compares with ours. If you found this useful, consider subscribing and also check out other videos where we break down more microcap companies and SME companies. If you're interested in joining our small research first cohort, the link to apply is in the description below. Thank you for watching and we will see you in the next one. Bye-bye.